Ready. Oh, my Reapers. No, I got to get my Reaper going.
This is all going in.
Well, I'm not off my Reaper
yeah,
track.
well, it doesn't
because,
matter. Daniel's going to figure it out. It's all going in, and you know it. Tell us when your Reaper's going.
My Reaper's going.
Hit it.
It's Friday, February 23rd, 2024, episode 233. I'm Patrick Serezna.
And I'm Kevin Muir. This week, we welcome Chris Ritchie from Silver Crest Metals. We have a fascinating discussion about the long-term direction of precious metals, what he thinks the mining industry could do better, and why we're headed a lot higher. Then Patrick regales us with his technical voodoo black magic, where he tells us what he sees in his funny graphs in talking charts.
And then we end with Krayons with Kev and No Stupid Questions. And folks, stick around. We might even drink some beers along the way. Danny, hop on. What beer am I drinking today?
Well, firstly, did you manage to finish the chips that you have in your mouth right now? Because
Yes, I did. Thank you.
Okay,
yeah,
great.
I've been waiting to crack this beer open.
Okay, so Keys and John joined us originally to brew the smooth and citrusy India Pale Ale, which is fermented with timed additions of Earl Grey tea. Brewing up a storm in 1997, Marble Brewery is a microbrewery based in the heart of Manchester.
Yes. We went to the British beer here. It's an Earl Grey IPA, and it actually tastes fantastic.
Really?
Actually. And no, I'm not saying that. And it's 6.8%. You can definitely taste the alcohol, like when it's a higher percentage, you can taste it. This one, you can taste it, but it tastes really good, actually. Anyway.
This is going to be an interesting show then, huh?
I wonder, do you think it has caffeine in it? Because it's an Earl Grey? Anyway, Kev, give us the side effects.
Nothing in this podcast should be viewed as investment advice. Listeners should consult an investment professional before making any decisions regarding topics mentioned in the show. Side effects of too much huddle may include precognitive AI prediction disorder, receding trend lines, which I'm way past, and the psychedelic crayon deliriums, which Patrick suffers from way too often.
Way too often. All right, let's get to the guest.
It's our great pleasure to welcome to the show Christopher Ritchie. Christopher is, although I should really call you Chris, shouldn't I? He's the president of Silver Crest Metals, and he's a little bit of a different, like a departure from us, because we don't get people from companies on, but his roots are definitely on Bay Street, and he talks about a lot of things from a macro perspective. So it was when he was chatting with me about different aspects about the gold miners and gold and stuff like that, I said, we got to get you on the show. So Chris, thanks for coming on.
Thanks for having me. This is great.
It's going to be a lot of fun. So I'd love to get to know you a little bit more. You were mentioning before the show that you grew up in London, Ontario. When you were growing up, did you always know you're going to end up being the president of a mining company?
I think it's probably one of the last things I thought I would ever do. I took like history, political science, literature, nothing to do with rocks.
Nothing to do. All right. So you're actually a little bit of, probably going to be modest about this, but you're a little bit of a star athlete. Why don't you tell us, I guess I didn't realize, I knew you were a tennis star, but I didn't also know that you are an Australian rules football team star. So why don't we start with how sports kind of, I guess, led your early parts of your career in terms of school and stuff like that. Is that fair to say?
Yeah, I think sports is really interesting in life because it teaches you accountability. I mean, when you're playing a single sport, individual sport like tennis, I mean, if you're, being lazy, not working hard, and you go out and lose, there's no one to point the finger at. So I think there's a lot of early year accountability, responsibility, dedication that translates beautifully into the rest of your life. Accountability in the adult world is shockingly lacking in many ways. So I think that was a big one for me. And just the competitive fire, right? I think really kind of, working around the edges, working the long hours and truly wanting to compete and quote unquote win translates really well for a lot of athletes into their later life. So for me, yeah, I still, as an old man now, I still poke around in tennis. I don't play Aussie rules anymore. My body couldn't take it. And I'm starting to play a lot of paddle tennis too. Which,
you are?
Oh man, yeah. It's much easier than tennis to get started and just way more fun. And at least I feel like I can get better at that, whereas tennis is just going down a steep hill.
So now you were very competitive and you played collegiate tennis at University of Miami. What was that like?
It was fantastic. I mean, it was a lot of hard work. You practice every morning. You shove all your classes in from 8 till noon. Then you go back out in the court all afternoon. And then you have study tables and you're pretty busy there and you're competing all weekend. So it wasn't a typical college experience in terms of fun times and whatnot, but just a different sort of fun. But being in the States for school was fantastic. It's a totally different experience down there. And, you know, I'm lucky to have had it.
I realized I got that wrong. You weren't at the University of Miami. You were at Miami, Ohio, right?
Well, here's your trivia for the day. It was actually a graduate from Miami of Ohio, which is named after a First Nations tribe down there. And he was an engineer, and he was a part of surveying the state of Florida and whatnot. And they actually named Miami, Florida after us. So,
I didn't know that.
You know, I had to get the T-shirt when I came home from school that was Miami was a university before Florida was a state.
That's awesome.
Yeah.
Okay, so did you give pro tennis a try?
I on a very low level, I played some sort of team tennis over in New Zealand and some sort of low-level tournaments to pay the bills. And I basically would play half the year and then travel half the year. So where I went to travel was based on how I would do. So if I played well and did well, I was traveling through Europe. If I didn't do so well, I was going through Southeast Asia.
All right. And at a certain point, you decided that you weren't going to be the next tennis star. So you went back to school. At that point, did you kind of have finance in your sights?
I did an MBA in finance, but I really had no clue about it. So it was kind of like, I could pick up a marketing book. I could pick up a strategy book. I think those things I could gravitate towards, but I mean, you know, I was never going to pick up an accounting book on my own, right? So I needed a bit more of a formalized finance background. It was pretty painful actually to go from having, I think, grade 10 statistics to jumping into a finance major. But, you know, you learn the language of business. I can't say I learned a lot of practicality there. I would disagree with most things I think I learned on the typical finance classes back then, but it certainly at least gave me the transitional ability to jump into finance from there and, you know, do what I really enjoyed, which was kind of being on the, you know, Bay Street, Wall Street like you. And, you know, you get to be an armchair quarterback. You get exposed to a million different companies. You see all kinds of great decisions, bad decisions, you know, evaluating risk. It was a great sort of foundational first step.
So you got a job, like a lower level risk management job, but then eventually you worked your way on to the institutional equity sales team, and you've been in some great shops, UBS, Canaccord, and National Bank. What were those like, and what years were you doing that?
Oh, man. So, I mean, I was kind of the late 20s, 30-year-old fetching coffee at UBS as I started out trading and just kind of, you know, learning the ropes. I was at Canaccord during the financial crisis as a trader, which was
that must be
pretty fascinating. And, you know, one of the best life lessons I ever got was I took out 3 line of credits and I had read The Wealthy Barber over and over again about compounding. And I bought bank stocks on margin because I thought that extra 1 or 2 points compounded for the next 30, 40 years was going to make me a rich man. And I got taken out to the woodshed on like Royal Bank and CIBC stock, you know, and not the junior uraniums, but,
so you did this before, this was before you, by the way, that's how very Canadian of you.
I know.
You thought you were going to lever up the bank stocks because they only go up. And then listen, you weren't wrong. It's just, I guess, a question of being able to stick through it.
It's ironic. I never truly comprehended until I was getting pretty large, sizable margin calls every day for about 2 weeks straight that I actually even had that much risk on the table, right? And, you know, watching the market roar back, you know, in your face while you're not remotely positioned to take advantage of, you know, cycles and the like was probably one of the most formative, you know, learning moments for me on risk management and, you know, how to be opportunistic and waiting for your pitch. And, you know, that's a big issue. I think a lot of people just don't really price in resilience, right? And really do the appropriate stress testing, especially in a world where you get sort of the levered funds in the US now that are just, really, putting the foot on the gas in terms of leverage.
And speaking of, levered U.S. funds, so what were the clients that you were covering? Were they typical Canadian institutions, or were you also covering the big U.S. hedge funds like the fast money guys?
Yeah, halfway through my time at Canaccord and then all my time at National Bank, I covered U.S. Like New York was my geography, right? So I was there back and forth for about 7 years, off and on, and it was whoever I could get to talk to me, really. And, that meant the odd pension fund, mutual funds, a lot of fast money funds. And you get a really good smattering of what they care about, their mandates, their process. And it really taught me a lot about how fickle people are, how like the career risk of the people you're talking to dominates their decision-making, as opposed to people who are willing to stick their neck out at opportune times.
Okay, why do you explain what you mean there?
If you're a big New York fund and you own Apple and Microsoft and all the sort of, like magnificent sevens and whatnot, you're not getting in trouble if those things go down. I mean, everybody owns them. You're kind of wrong with the crowd when you're wrong. If you buy some stock that's, in a different market, you stick your neck out, you don't need to be there. It's in a sector that's got a small weighting. It's kind of against your benchmark, things like that. And you're wrong. That thing sticks out like a sore thumb to your boss and your portfolio manager and whatnot. So I think there's a lot of people that were just reluctant to, step outside the typical set of ideas. And I think that's such a great investing paradigm that, once you step outside of that traditional set of ideas, everything is very different because fewer people are there.
I think there's people that actually say, like, I purposely moved away from New York or Toronto or wherever it is because I wanted to get away from the groupthink mentality. Meaning that, like, just as you say, everyone owns the same stocks. And even if it's not the Magnificent Seven, if it's the same kind of 7 to 5 wise guy stocks that everybody owns because they're smart plays, they all talk themselves into it almost as a group.
Absolutely. And I think one of the ironies for me at the end was, why I left was, I had a compliance officer. Well, I guess the whole national bank, they made a rule you weren't allowed to own any of your own stocks. You just had to, abdicate your own decision making. I was like, hey, I'm in capital markets and I can't control my own portfolio. And part of it was they said it was a conflict of interest for me to talk about stocks I owned. And I said it was a conflict of interest to talk about stocks I don't own.
That's true. If it's so good, why am I not allowed to own it?
Yeah. But, so it was, I did like the idea of stepping away, and that's how I transitioned. I just thought I stopped learning. I didn't like not having skin in the game, going back to sort of my time in sport. Like there's only so much coffee you can drink to stay awake when you're just really, just clipping a paycheck. Right. I just was bored and I just wasn't learning.
I got in trouble, Chris, for trading against the clients. And they used to say, like, but you're trading against the clients. I go, well, they're phoning up. They're asking for an offering. So I show them an offering. And I'd be like, it's better that than me running ahead of them. Like how?
Yeah, exactly. You're providing them with liquidity.
I didn't understand why this was a problem. They said, because you're trading on the other side of your clients. And I'm like, well, no, it's not that big a deal. They want an offer. They want a bid. I provided it. Okay.
It's called a stock market. It's open from 9:30 to 4 every day.
All right. So you decide that Bay Street is no longer for you. Do you go looking for a job on as a kind of working for a mining company, or did they come knocking on your door?
No, it was interesting. So Silver Crest Metals, where I'm at today, they had a predecessor company called Silver Crest Mines. And the CEO, Eric Fear, he's a geologist, mining engineer, and he had built up a tiny little piece of property from nothing to a mine all the way through it. And I had sort of got to know him halfway through his process and helped him raise money. And when they ended up selling the company. And that's also a funny story because I was switching from Canaccord to National Bank and I was like, hey, switching jobs, I'm negotiating a new salary. Can I get the M&A mandate if and when it ever happens?
Yeah. Did they give it to you?
Yeah, no, like I'd done so much work for him that he was saying, yeah, sure, you've earned it.
Oh, great.
And that company sold. And it started out as the new company, the one I'm in today, was just a $5 million shell, essentially. And I, helped them raise money. And about, a year later, I was, chatting with Eric, and I just said, hey, we got to do this. We got to do that. And he just said, well, do you want to join? And I was like, whoa. Then he said, do you want to be a CFO? And I was like, you do not want me as the CFO doing the accounting. I got 49% in my final accounting exam in MBA. They just kicked me out of there. So it was an opportunity there. And he was kind enough to sort of make sure he wouldn't let me join until he thought we had critical mass, which was interesting. And then I was so bullish and naive that when I quit, I took a 60% pay cut and I put everything I had in it. And if you asked me now if I would do the same thing, I would say, no way. I just know too much now. But it was, I wanted to learn. I wanted to grow. And I thought at the very, very least that I would learn so many new things that there would always be a seat for me back in the old job in a smarter, better way than if I didn't take the chance.
Right. But it's been a while now, so I don't think you're going back to the old job. Okay, so let's talk a little bit about your macro view of the world. And obviously you work at a precious metal company, so you're going to be biased for kind of gold and silver especially. But why don't you tell us, let's just start with why you think this asset is something that everyone should be paying attention to and why it should be part of their portfolio.
Yeah, I think there's a really important dynamic here in that we have really become accustomed to using, our paper currency, our Canadian dollar, US dollar, and the like. And it's really convenient. It's well established. We're comfortable with it. And somewhere across the line, we've lost sight of the fact that it doesn't actually serve as a store of value, right? We've conflated the two issues. And when you start to dig and scratch at the surface of that context or concept, you get into things like demographics, where, we're now sitting in a place by the year 2030, 100% of the baby boomers are going to be over the age of 65. So they're exiting their large tax-paying years. And we're in a situation where the debt levels are obviously incredibly high. I think Canada printed 10 times the amount of debt versus GDP just during COVID to sort of try to get us through it. And that we've just become overly reliant on debt and printing money. And when you start to dig away at the paper value just has not held up, right? Like the paper value or paper currencies just don't store wealth. And it's just something that's not well understood at all. So like, the US dollar has lost 98% of its value versus gold since, we came off the gold standard in the early 70s. And there's examples of, take the housing price in numerous markets and you'll see that it's kind of going up anywhere between, 8, 9, 10% a year, which is pretty much lockstep with the amount of new supply of paper currency per year. So the more you dig into it, you realize that, it's not just gold, silver, but just hard assets in general, just things that you can't increase the supply of easily, are holding their value more than things that the supply can be increased easily. Like, for example, if you go from 1960 till today, the US federal government has increased the debt ceiling 74 times. So, do you want to store your wealth in something with infinite supply growth, or something that's really hard to increase the supply of?
Okay, so you are younger than me, Chris, but not by
much.
Not by enough that you probably prefer the bits in the sky over the gold. And I'm sure that all the young people are listening to this going, you're spot on, man. But why are you buying this old, archaic metal? Why don't you buy the new gold, which is Bitcoin / cryptocurrency? What do you say to those people?
I think we're all on the same team to a certain extent in that we are challenging the efficacy of fiat currency. So I think as a sort of a starting point of the conversation, I think we're on the same team, even though I know that the cultures are clashing. Cryptocurrency, it's very new versus gold having stood the test of time. The data sets around gold over time is, something that's probably easier to rely on. I think how Bitcoin has traded is more in line with the NASDAQ than more in line with a store of value. It's not to say that it can't be that, it won't be that, and it's maybe not even better. I just think for me right now, the patient preservation of capital element of gold is in how that's traded is just to me a little bit more secure. And we've all seen the blowups and whatnot, and that's just part of any nascent industry. So
Right.
I'm not against it. I just I'm not there yet.
I got it. I always say that when you own gold, like you own physical gold, you own physical silver, it is truly nobody's liability. There, like you have it on yourself. You are relying on no one. And one of the worries that I always have with the cryptocurrencies is that you still have a liability. It's the liability against the network. And
yeah, I mean, we've seen the stories of, I think one major cryptocurrency exchange, the person passed away and he had all the passwords and
yeah. But even if you say what the crypto adherents would kind of push back on and say, no, but that was an exchange, which is a lot different than the actual Bitcoin network. And I always say, well, what happens if tomorrow, China and the US, get into a fight and they cut off the fiber between those two countries? So then,
oh man, there's a great book called, I think it's called 2034.
Oh yes, about the war.
Written by, I think he's like a 5-star general or admiral about exactly that scenario, Kevin, where China disables all of the sort of technology of the US and they're, fighting wars with, slingshots effectively, right?
Right. And so I always say that you still have a liability against the network. And so ultimately, if you have that situation, you're going to have two forks and there's a million things that could go on, or the government can, at the end of the day, the government still controls the internet. It's like it was made by the government. And to me, I'm with you. I think the gold, silver stood the test of time. It's been a store of value for millennia. And I just think that it truly is nobody's liability. Now, one of the things I was laughing about, though, you're going to appreciate this, Chris. Tom Lee got on TV the other day, the strategist for Fundstrat, I think is this firm. And he says 150,000 by year end is his prediction for Bitcoin. And then one of the traders on the desk said, if it does, GDX will be $12.
I actually love a lot of the memes they have with, the gold and silver guys. I think it's great. And that's also kind of, factors into what we're doing on, at Silver Crest. But yeah, I think it is interesting and it does beg the question on innovation and the like. But
okay. So we have to talk a little bit about, fine, we can be bullish on gold. We can talk about, we probably all understand the story about why over time gold and silver are a great kind of store of value. But one of the things that has definitely not been a great store of value is the mining industry as a whole recently. And it's obviously GDX as the gold miners is frustrated a lot of people. And I was just wondering, what do you think are the issues that are making it so the stocks themselves of the mining companies in general, we're just talking about in general, are struggling?
Yeah, absolutely. I mean, when you invest in a mining company, especially if it's an early stage mining company, you're not investing in gold and silver. You're investing in, can the team find a deposit that is sizable enough to justify taking it out of the ground? I saw a data point from the Colorado School of Mines. It was in the Globe and Mail. Said approximately 1 out of 750 projects actually makes it to production.
Okay.
So yeah, if you're investing in one of the 750, then yeah, you've got a lot of risk, and a lot of companies don't make it. And then
what about the seniors though? The seniors that are supposed to be, they have the assets in the ground. It should be more predictable and they should be doing better. Yet it seems to be that even though gold is at all-time highs or close to all-time highs, and that in itself is amazing, the gold is up here and nobody's bullish.
We took an interesting data point, Kevin, and it really shook me when I looked at it. We took a data set of 400 mining companies from 1990 to 2021.
Okay.
And we looked at the compound annual growth rate of their operating costs.
Right.
And that big data set over a long period of time went up 8% a year. So and the correlation between the operating costs and the gold price was 0.97. So it actually told me that when the gold's in the ground, you're not actually capturing any of that margin expansion over time. And so one of the conclusions is that gold is inflation, right? Which is what it tells you that.
Okay.
And then what we've seen is the inflationary pressures over the last few years have absolutely beaten up the margins of all the companies. Like we're in Mexico, our labor over the last 3 years went up 50%. Right? Your energy costs go up, your input costs go up, like your risk of dealing with governments in strange jurisdictions, your ESG compliance and the like. And, there's a bit of a, slightly dishonest or at least unclear is when companies in the mining space report an all-in sustaining cost.
Okay.
That all-in number isn't all in. That's an all-in operating number. What it actually excludes the cost to buy the property. It excludes the cost to explore the property. It excludes the cost to actually build the plant. So there's a lot of guys out there that the total cost to get a pound, a ton, an ounce, and this is all commodities, a barrel, out of the ground is quite often, at the price of the metal today or the whatever it is, or even higher than the price. So it makes it a really, really tough industry, but it also speaks to the products themselves do serve as a better store of value because the scarcity and the supply growth is quite challenged.
Right. So one of the thoughts that you had as like in the industry as a whole is that, and you just touched upon this, is the fact that you guys as a whole are pulling this, this metal or whatever it is, like as you say, oil or whatever, out of the ground for almost too little, meaning that you're not being disciplined enough at curtailing supply. Is that correct?
Yeah, and it's interesting because if you produce iron ore, it is like it's called a bulk for a reason, right? Like you can't just decide to put it in your backyard. Like the logistics around it, it's just impractical for companies to create the storage to hold back supply. I mean, if you were producing toothpaste as a business and it cost you $5 a tube and you're selling it for $4, you just stop producing as much. But for mining, once you turn the spigot on, you pretty much have to get it out the door and move on. The interesting thing with gold and silver are two things. It's easy to store and it does serve as money. And the past track record of how gold's performed over time has beaten fiat currencies. So part of that angle is, shouldn't every company have a governance obligation of trying to preserve the purchasing power on the balance sheet and examine all the instruments available to them to do so? And it just so happens that the mining industry struggles to get a product out of the ground at break even today, but then a typical mine takes 15, 20 years and they're 1 out of 750 that make it. So why would you think the next generation of projects is going to be a lower cost when you've got that 8% a year historically? And this applies also to the cost of a pipeline, right? Any hard asset that needs to be built. The concept of book value is an accounting term, but the way we look at it as what's the cost to replace it? And I just think in our investing world, not too many people are really thinking about 15, 20 years from now, where is the next wave of supply going to come from when the financial incentives barely exist today, let alone the risk 15 to 20 years from now?
And to your point, you're looking at this and saying, well, if this, we're going to have trouble bringing upon supply, why is the industry as a whole selling this asset that's going to be worth more tomorrow? Is that, if I kind of got your thinking correctly?
Yeah. In about a year and a half, when we were entering production, we were deciding, okay, how are we going to allocate capital going forward? And the question we think everybody needs to have is, okay, let's start out by saying, how much money are we making on this enterprise? And what we did is we took every single penny from day one till today, and then we divided it by the number of ounces that are in the reserve category, which means they've passed the scrutiny of being economic, and we're higher than the spot price today. So if that's the case, and we're one of the success stories, we were 8 years instead of 16 years. We're one of the lower cost operators. We built it on time and on budget. If this is our current scenario, why do we think we can sell it and get the same ounce back in our hand 15, 20 years from now at a lower cost. So I sort of challenge the idea that going out there and increasing the supply was detrimental to our business or industry, and that holding onto our product itself was a way to reduce supply. We get to participate in the upside. The ounces we hold, don't have any more costs associated with them. So, I wanted to put on the table that actually was a choice. And you're seeing this also in the energy business, right? No one wants to give them capital. No one wants to invest in them. Really hard to get permitting. And they've said, all right, we've got to be self-reliant. We're not going to build new projects. We're going to do M&A instead, and we're going to buy back our own stock. And all this leads to a medium to long-term shortage because the Western world does not see commodities as strategically valuable products.
As you explained this, it actually came to kind of like it jumped up at me that, are you not suggesting to a certain extent that the precious mining industry does kind of a Michael Saylor MicroStrategy approach, where they hold the asset they think is the ultimately the asset that will outperform cash?
Yeah, in a sense, right? Like if we know or look at the data, and we're an industry that says we believe in gold and silver over fiat currency, we know that any politician getting into power over the next 20 years has to get voted in by the baby boomers who are going to want more healthcare and things like that. The printing presses won't stop. So, the paper currencies are going to lose value, or at least keep on the same trajectory. At least that's my bet. So we're including gold and silver as a currency to manage alongside our other currencies. So to give you an example, we have Mexican peso exposure, right? So we hedge that. We have Canadian dollar exposure. We hedge it. Well, how do you hedge your US dollar exposure? And we looked at it and said, hey, if our costs are going up 8% a year, and gold has actually outperformed that 8% a year, our gold holdings on our balance sheet hedge our own inflation. And we actually did back testing for McDonald's, Johnson & Johnson, Home Depot, General Electric, just any old company, and said, if they kept gold on their balance sheet 10%, right? Not all of it, but just 10%, would their balance sheet be in a better place today than it was 20 years ago? So all you have to do is look at the performance of gold versus the dollar, and you'll get your answer. So again, it's that reliance on fiat currencies, or that confusion that fiat currencies are stores of value. It's a topic I want people to talk about. I think it's a governance topic. I think every board should have to figure out, how do we preserve our purchasing power, especially if we're an industry that allocates large sums of capital over long periods of time.
I get it. So you're in essence using gold as an inflation hedge. And you're saying, like, why, if we know that the dollar is going to go down over time versus gold, then why are you holding any dollars?
Yeah. And I think out of the gates here for us, like we're taking a quite measured response, and we want to have a healthy conversation with everybody, but that's exactly what the data shows.
And let's talk a little bit about social media and how it's kind of changed the environment about pricing stocks. And one of the things that was interesting was, like, during the GameStop phenomenon, like, that was eye-opening for everyone that had been in the industry for a while, because we've never been scared of the right tail. Like, maybe David Einhorn was scared of the right tail because of the Porsche Volkswagen thing, but everyone else has never been scared of the right tail. But yet we had the kind of COVID-induced, like, people trading at home, kind of right tail events, the likes that we haven't seen forever. And for a little while there, it seemed like silver was almost getting some traction in terms of that kind of social media and the young people liking it, but it fizzled out. I was just wondering what your opinion is about social media in terms of pricing stocks and trying to introduce new investors to this type of assets, and maybe where your industry could do better, or whether they should care about this at all.
Have you seen the movie Dumb Money?
Yes, I have.
It's an interesting one on that behalf. I think it's very interesting. My girlfriend gave me a book called The Brand Flip, and it blew my mind, because it was saying a historic company Well, first of all, it starts about Peter Drucker. He said, Peter Drucker said, hey, the main purpose of any company is to find a new customer. And I was like, yeah, duh. And then it said, but the main two functions are to innovate and market. And then they go on to talk about the fact that a company of the past would create a product, and then they would create a brand and go find a customer. And they're saying with social media, with the ability of things to go viral, that the new company is one that they actually create the product, they get the customer, and the customer creates the brand. And if you think of things like Tesla, I think it's a great example where people are like, hey, I'm buying a Tesla, I'm saving the planet. And you get to feel part of this collective group. And they call it a tribe in the book. But you're part of this collective group that actually do your marketing for you. Okay. So I think that viral power has been very underutilized. And you and I both spent our days in, institutional side of things, and you're dealing with big institutional funds. They're professional people. They know what they're doing. And that other audience, that very big and powerful group of retail individuals that can really have an impact, $5,000, $10,000 at a time, harnessing that group has been something that the mining space has definitely not tapped into. But you've seen it on the crypto, right? I mean, that audience is like almost the polar opposite of gold and silver, right? The demographics of the typical gold and silver investor, you got gray hair or silver hair, maybe that's better. And it's the exact opposite of the Bitcoin people who have a huge place on the web, right? So I think it's incredibly powerful. I think there's all sorts of innovation that can take place on that side. Hopefully it comes with a lot of credibility and honesty.
And so what would you say to your fellow kind of mining companies in terms of how to harness that?
Yeah. So the first thing we do is we try to tell a lot of the truth, so our comments about, the risks and the costs, and really making sure that's clear to people, but then to bring it back to that, it does make the product more valuable when it is hard to increase the supply of it.
Right.
And that really puts us in a different category, because as far as I know, we're the only ones eating our own cooking, right? We're the only ones that are holding back some gold and silver, right? So,
and do you think that is the biggest bullish argument for like gold miners as opposed to owning the gold and silver itself? In that an asset, a company with a big asset that it will be worth a lot more in the future, or would you say to the or would you just argue like why would someone go and choose a miner over the actual silver or gold?
Sure. I mean, it's leverage. I mean, if you're asking yourself, are you investing in a business or are you investing in a vehicle? And, typically the weighting in the MSCI for, material stocks is about 1.5%. Today it's at about 0.2, 0.3. If you look at the long onlys in the hedge funds, they're significantly lower weighting today than historically. And because it's such a small space that, if and when we see gold and silver get a shining moment or the Fed wants to cut rates, because the space is so small, incremental amounts of capital coming into the space can outsize the returns on the equity side, as long as people are very aware that, again, the risks of that particular instrument over the metal is different. I think also, Kevin, and like a big deal is like we live in a world of instant gratification. And people's time horizons on investments, quite often are going into the 1 day till expiry on that.
Yeah.
That whole phenomena, right? And then, quarters or months for a lot of fund managers who are under a lot of pressure. Very few people are willing to look at the time horizons that would showcase that gold has done an amazing job over time, right? So it's just the time horizons, aren't quite there. So I do think our industry needs to do a better job at allocating capital, educating people on the risks. But again, it does mean that, in the West, I just don't see the next generation of supply coming online anywhere near today's prices.
Okay, so you talked a little bit about the time frame problem that a lot of investors are under, and I would argue that this headline that we got today, this morning, that Elliott Management plans to spend $1 billion plus on mining assets, is actually a perfect example of somebody arbitraging that timeline, because I would think that Elliott's taking a longer term view about things and saying, no, well, these assets are super cheap. We're going to buy them, put them away, and wake up in 10 years, and hopefully they're going to be a lot higher. Do you think that's what's going on there?
Yeah, if you go back to 08, 07, 08, before that, China was growing like a weed, and everyone was moving to the big city, and they were consuming all sorts of commodities. And I was at Canaccord at the time. I think we averaged a deal and a half a day for about a year and a half over there. Every every commodity company could get money, no matter what. And we're on a 15-year hangover from that. And the typical mining cycle is a little bit less than that. And once inventories get low, that's when capital starts to come back in, and you start to see the new projects start to move forward. But this huge inflationary wave we're seeing in the last couple of years has kept that capital away. The ESG movements kept that capital away. So yeah, you do, seeing those headlines like today are people now acknowledging that the lead time required to see new supply is so far away, and that the CapEx that's been allocated has been so low that something has to give. So if you're the only game in town and you're going to swing a big stick, and you can get access to, any good project that you want, because there's no marginal buyers out there. Yeah, I think it's a great example of someone trying to come in and get involved at where they believe is a really interesting time in the cycle.
All right. And so when you're thinking about gold and silver, and you're thinking about where it'll be in 5 or 10 years, do you think it could beat the returns that we've experienced over the last 5 or 10 years because of this supply issue that you're talking about?
I don't expect to change the industry with a lot of other people jumping on board. If you're a company that doesn't have the financial strength to hold supply back and you're living hand to mouth, it's pretty tough to do that. We're just fortunate enough to have choices.
Right.
But I do see no slowing down of money printing, right? Like, no politician can get into power without, giving people what they want. And I saw a great headline a few months ago. You'll love, Kevin, and it was Rishi Sunak, the Prime Minister of the UK. And it said, claims that the UK is headed towards austerity are simply unfounded, Whereas 15 years ago, it was like, we need to tighten our belts. We all need to live within our means. And here we are now.
It's so true. You've highlighted the difference. And I talk about it being the difference between the move from monetary stimulus to fiscal stimulus. But it's the same deal. Like, we forget that Barack Obama, he used to lecture everyone how we had to cut back on our spending. And now contrast him to Biden, who just spends. Like, it's we could be shocked at the amount of inflation in the coming years.
Well, you go back to the education, like, we're all there. All the politicians are fighting for votes, and Biden wants to forgive debt for students, and admirable, call it what you want. But my first question was, what about the people graduating from school next year and the year after that? Like, are you just picking a moment in time because it's an election year, or is this like an ongoing trend where you're just going to monetize, all this debt? And again, I just don't see any politician getting into power without catering towards that audience. So again, demographics is, you can't argue. And in China, the demographic numbers are collapsing. And again, the replacement rate is slowing. You're just not seeing the new tax base simply isn't there. And to use the analogy of like fighting a war, I mean, the U.S. bankrupted Russia by just outspending them, and the U.S. has the reserve currency that's really not going away.
Right.
They can outspend,
yeah.
And Russia can't do that. China can't do that. China's increased their money supply by 800% since 2007. And I read a great book where the author said, I'm not even sure if China even thinks of their currency as a store of value. Right.
Sure.
And I was like, well, if you're increasing it by 800% in 15 years, then yeah, that's a fair question. So, Yeah, I don't see a way around it, and I don't see the masses, especially the people really beat up by this inflation, ironically, um, allowing governments to stop doing what they're doing, even though they're the worst losers in that scenario in the long run.
So to get kind of paraphrase why you're bullish on both the commodity itself and actually the companies as well, we had this kind of spending spree that occurred during the 2005 to 2011 period, when it was just when every single mine that could was financed and put into production. And as you say, those are long lead time, and the life of those mines are long. And so now we're in a situation where even though the price of the actual commodity is up, they're not making any money because your costs have gone up just as much. But ultimately that means there's even less mines going into production. And in essence, what we're going to have is the regular cyclical up and down. And then when you combine it with the change that has occurred in terms of government's attitudes towards spending, this could actually occur at the same time that we're getting more inflation than we've ever had. Is that a good summary?
That's a great summary. And I mean, if you think about a country like Chile, right? They nationalized the copper industry in, I think, somewhere in the 70s, and they used the cash flows from those stolen assets to fund huge parts of their government. And now all the mines that they had are getting really, really long in the tooth. And now who's going to go build the next wave of projects and put that capital in? And if you're a government, you're now saying, well, we can either spend money on education, healthcare, or mines, right? It's a very tough sell politically. And so I do think that next wave of capital is going to be quite challenged. And, another data point saying in the United States, 50% of the mining related workforce is going to retire this decade. So even if you do see a huge spike in the copper price, nickel price, and the like, everybody's going to be rushing out to get the same mining engineer, the same electrician, the same underground miner, and whatnot. There's just going to be labor inflation that, again, moves in tandem with the price. So, having, the ability to allocate capital off cycle is hypercritical, but the companies now do not have the capital to do so.
And so ultimately that is that kind of worry about this, the kind of your production cost inflation, like not allowing margins to expand, is why your argument is that you should keep more of your assets in actual gold or silver.
Yeah, like I do think, costs can slow down, right? Like I do think we're going to catch a break here at some point, and we will see margin expand.
Right.
But at the same time, if you think of a royalty company or a streaming company, they're given a better multiple in the marketplace because they're giving an investor exposure to the product they want with less exposure to the operating risks associated with getting it. Okay. So what we're saying is when we sell an ounce that we've just produced for $1, we're now doubling down on the operational side of things, right? We have to go find a new project, reallocate it. Whereas if we convert that ounce into an ounce we hold in a vault, that particular ounce should be given a better multiple because it's similar to a royalty or a streaming company because you're giving your investor what they want exposure to without the same operating risk.
Okay, that's fascinating. You have a stat where you mentioned the fact that Barrick Gold, I think it's like roughly unchanged over the last 25 years, or it hasn't done very well. And then you compare it to the price of gold. Gold has obviously exploded in that period. But I kind of would love to get your thoughts about, like, if you did Franco-Nevada or one of the other streamers, they've done much, much better. Is that almost all attributable to the problems with the operational inflation that you're citing?
Those are great examples, right? If you are a streaming company and you say, I'm going to invest in you, I'm going to give you $300 million and I'm going to buy X percent of your production at a fixed price. If that operating company has a labor dispute, their costs go up, taxes go up, fuel costs go up.
I just realized actually when they do that, they're actually, isn't the mining company doubling down on their operational exposure?
Exactly. Right. And the royalty and streaming company is doubling down on the product.
Oh yeah. So like they shouldn't be doing them. Like all they have to do is look at their stock prices to realize they shouldn't be doing them.
This goes back to the challenges, though. I mean, if you're trading at 0.4 times NAV and a royalty company is saying, we'll pay you 1 times NAV, but, that's a much better cost of capital in the short term. But what that royalty and streaming company is getting is we get a stable stream of the metal at a fixed price.
Right.
So that 8% a year where your costs go up, they're immune to that. They've just captured the margin expansion because they get a fixed price for their product over the life of the mine.
Right.
They've just clipped the margin and reduced the operating expense. So, if you don't have capital in a really, really bad time, those are the deals you do. And that's the cyclicality of this industry. So right now, the mining industry, really suffering from inflation, cost of capital is up, access to capital is down, inventories of all major commodities are running pretty low. And the next generation of projects are nowhere to be seen. So it makes the industry challenged, but it makes me wildly bullish on the price of the commodities themselves.
Got it.
Hence our belief that, fine, let's double down. Let's put our foot on the gas of this whole topic and let's reduce the supply ourselves.
Right. And no point selling it because we think it's going to be a lot higher later.
Yeah. It's just a choice. We just want it included as a choice. I mean, if you think of it slightly differently, Kevin, if I was to give a dividend, okay, great. Investors are happy. And then one day I need to go build a new project. If I don't have enough capital, I got to go raise it. And if, it's not the right time to do so, there's risk in raising it. Whereas if I hold on to the metal in some way, shape, and form, I'm actually giving my investors more exposure of what they want. I'm reducing the risk associated with that exposure. So I am allocating capital in a way, and I'm keeping it.
Yeah.
Right. So I'm retaining that flexibility to manage cycles. And this is what I do get pushback from some of the portfolio managers. They're saying, hey, it's not your job to allocate capital. I can go hold silver and gold myself.
Right.
And I say, well, it is my job to allocate capital. We allocate lots of it. And you don't complain about me holding US dollars.
That's
right.
A good point.
And, and in fact, again, we allocate large sums of capital over long periods of time, and gold's done a better job at preserving our purchasing power. And not to mention, going back to your point, we're the only company I know of the 500 or so mining companies that's holding on to it. So my ability to go back to your topic of social media and marketing and differentiation, we've now created totally differentiated message, right? Hey, we believe in our product, come with us. Let's change the industry together. Buy a couple shares and, let's force the rest of the industry to have this conversation. Let's look at the data together. And by definition, we're a commodity. So instead of 500 mining companies all doing the same thing, how do you win in the cost of capital game when you're doing the exact same thing as everybody else? So everything you're saying about the social media side, like we are attempting to partner with the wholesalers and the retailers that sell the physical metal, on e-commerce sites effectively, to say, hey, take a peek at us as a mining company. And if we can convert a very small amount of the purchasers of the metal to be purchasers of our stock, that at least gives us a shot at something new and different, because the audience for our space is, we've turned over a lot of rocks. I can't find that many more.
Well, I'm going to tell you the apathy and the disgust actually of like GDX of any metal miners holders is just out of this world. Like it is so bad. Like it is just so bad. It's like
I totally agree, and I'll give you a data point that we think is very relevant. And you can check my numbers here. As one of my colleagues put it together, so it might be a little off, but he said that the BRIC countries, right? They, if you take 1% of their foreign reserves, because we know they all don't want the US dollar, but
Right.
there really is there is no alternative in the paper currency world. If you take 1% of their foreign reserves today, it's the equivalent of 27% of the annual mine supply of gold.
Yes, it's because you're including China. China's FX reserves are through the roof. And this is my argument of why gold is going to keep going up. And everyone keeps focusing on the rates and the US dollar. And I go, it doesn't matter. All that matters is the fact that China's looking at it and saying, I have to diversify out of US dollars. And gold is like, even if it's not the major thing I own because I can't buy enough gold, I still am going to be on the bid forever. And that's sorry, go ahead.
Yeah. And the central banks are effectively just hedging their own behavior.
Well, that's
right.
true.
When you see them out buying gold, but I don't think the US dollar is going to zero. I'm not an end of the world person. I just know that the marginal demand for the dollar is definitely in question.
Yeah.
And there is a marginal shift. And I would go so far as to say, I would venture that these major economies, especially industrial commodities with a manufacturing population or base, could consider stockpiling commodities themselves as a form of store of value, because the price is most likely to go up in the future because of the dynamics. It is an alternative to fiat currency. And at the same time, you can support your domestic industries. Like you're seeing China do that with rare earths. You're seeing Indonesia say, we're not letting nickel out of the country unless it's been refined here. The whole deglobalization or resource nationalism. I do think that these commodities serve as stores of value, but also strategic assets.
Canada to take a lesson on that, eh?
Oh man, it's we're gonna find out when it's a little bit late, and this is where the sort of stagflation sort of kicks in. Is if there's no one entering the workforce for commodities, and there's no capital being spent, the input costs of all the things we use are going to go up.
Right.
We hate them, but we use them.
Yeah. Oh, I completely agree with you there.
We'll be short. So one day we'll be short.
Yeah, and back to your point about the central banks, Chris, I was noticing and thinking about that, and the fact that the central banks are the main buyers of gold means that the typical investors that might have bought gold because they were worried about the US dollar going down or interest rates going down, they would have also bought the actual miners. And yet, in this case, we're actually not seeing any financial players buying gold. Or at least I think it's limited. And I think that's part of the reason that we see the miners doing so bad is because the central banks aren't going to go buy, Newmont and Barrick.
No chance.
Right? So,
well, in an indirect way, I mean, you're seeing like China imports approximately 70% of their raw materials, energy, and food. And who are China's best friends, right? They're making friends with Africa for the raw materials, the Middle East for the energy, and supporting Russia in their war with Ukraine for the food. So I think in an indirect way, they're looking at the entire supply chain to access the commodities and investing in that, but I don't think they're buying tickers.
Right. And I guess my question to you is, do we just get a situation where eventually the price of gold pops because of these central banks buying it? And even though you guys are struggling with inflation on the cost side, the margins expand just because of the central banks. And that is ultimately what drives the next move higher in the miners.
Exactly. So when you look at, again, we talked about lack of CapEx and maybe there's lower supply coming, maybe there's an industrial boom for silver, for, solar power and other things because of the conductivity and the usage there. But, for me, there will be a dislocation if the supply of the metal itself is somewhat curtailed, and if that means the commodity producers scratch their head and say, I actually have leverage in this conversation.
Right.
I actually control the supply of the product, and guess what? This product has actually done a better job than fiat currency to preserve value. And I also think it will help my multiple on my balance sheet versus $1, right? Why don't we just accelerate this conversation and let us hold back the supply?
Yeah.
So again, that's the difference of the bulks having to sell their product because you just can't logistically store them versus gold and silver.
Oh, okay. I get what you're saying there. To me, it feels a little bit like uranium. We all sat around and uranium was trading at this dumb price, and we all knew eventually it was going to pop, but it was until the demand came for the physical, it was tough to get anyone excited about anything. And then once,
absolutely
right. And then it was just kind of all of a sudden the physical took off and people are like, wait, and stuff. And they're repricing the miners. And it was the start of it all, but it was kind of really the physical had to go first.
Yeah, it's just basic supply and demand. Imagine if all the big producers of gold and silver said, we're going to hold back a certain percent of our production, or we're going to include gold and silver on our balance sheet as one of the currencies to be managed, right? They have a new marketing angle. They can go after, I mean, that's what the Bitcoin miners do, right? They hodl,
yeah,
right? They eat their own cooking.
Yeah.
And people have grasped onto that dynamic, and they support the fight, right? It's a movement.
That's a movement.
And
so you're going to start the silver movement, and we'll say it all started here on the market huddle. Chris started the silver the movement.
I would like it to be just a conversation on, does our product serve a purpose within the functionality of our business? And I absolutely believe it does. And at the same time, it has other functions of, holding back supply and contributing to and being a better capital allocation choice.
Okay.
So
win-win.
It's just not everyone wants to talk about it.
Right. All right. I could talk about this forever, but we're going to have to actually cut it off. So we're going to go with the 3 questions that we end with. Well, first of all, what do you think is the hardest thing to do in trading and investing?
Oh, I would say showcasing patience and keeping some dry powder in your back pocket for those once in every, 3, 5, 10-year opportunities. And I go back to my borrowing money to invest in stock or bank stocks. And I watched the market rip back in my face, and I didn't have any dry powder.
It's like the really smart guys like Howard Marks and all those guys, they go out and they raise money and then they just wait for it. Like they've already raised distress funds and they haven't even put the money to work. They're just like saying, I think there's going to be a moment of distress where we can buy these cheap, but we need to be ready. And I
got to wait for your pitch.
Yeah.
And I think it's really hard to wait for your pitch. And again, going back to the instant gratification, delayed gratification society we live in, I think it's getting harder and harder.
Okay. So Don Cox used to say that you shouldn't invest on what is on page 1 today, but what is on page 16 on the way to page 1 tomorrow. Do you have any trades that you feel might get the Don Cox seal of approval?
I think energy is quite interesting because I think they're a couple years ahead of mining in the sense of they know they have to be self-reliant on their balance sheet. They had to clean up their debt. They're not running out to invest in new projects because no one wants to support them in doing so. And they're sitting here with really juicy free cash flow yields because no one else wants to invest in them. So if things get worse, they're going to be in a position to buy back their own stock. And if the market tightens up for oil or anything weird happens in the world, you've got a really cheap call option. So I like the asymmetry of that space combined with the resilience. And I do think there's an element of that in mining in the sense of we haven't cleaned up their balance sheets yet, but the lag in supply. I think there's an element there. So I do think the energy is there.
That's a great analogy. Patrick O'Shaughnessy, he's a podcaster. He used to ask his guests, what was the kindest thing that someone has done for you to help you along with your career? It's such a great question. I feel like I'm just going to borrow it and ask all my guests the same thing. Do you have someone that helped you out?
You know what? I was thinking about that, and Eric, our CEO now, I mean, he took a guy off a sales desk who had no experience in managing people, no experience in a mining company. And he threw me in the deep end to be the president, president with no one to manage at the time. And I just got exposed to every aspect of the business, and I had to just learn, which is my, I love learning. So yeah, just having the opportunity to not have a ceiling above me. So I thank him for that.
I'd actually love to explore that a little bit more. What is it like in terms of being around all these people that, very accomplished engineers and things like that. You must have been quite intimidating when you're sitting there and you're like, well, I know I can raise you the money. I don't know what you're talking about with any of these things. Like, the basics of what the market cared about, but there must have been a huge learning curve on that portion of it.
When I remember our COO told me the concept is like it's a known risk and an unknown risk. So if you don't know what you don't know,
right?
I didn't even understand that term. It took me literally months just to get my head wrapped around, the unknown risks that aren't even on your radar, and to start to see them, plan for them, bake on them, plan for them. It's there's a lot of moving pieces. So yeah, for me to sort of not be involved in so many aspects of it, but I'm curious. And, ask a lot of questions. So my goal in life has always been to learn faster than everybody else.
Well, that's a great goal. Okay. So there's a question that Brian Nick from last week left you. I'm going to play it here.
The question this week is, what is one misconception that young people have about the economy or the markets that you wish you could clear up with a snap of your fingers?
Oh, that's a great one. I think for me, it's the difference between a real return and a nominal return. We're all used to this concept of compounding, but we aren't really aware of the erosion of wealth over time. I mean, if you're making 8, 9, 10% a year in your portfolio, that's fantastic. But if the cost of living for things like housing are going up at a similar rate, you're just treading water, right? And then how you allocate capital changes. And again, like the housing price in Toronto is compounded at 8% a year for the last 16 years. So yeah, I think a lot of people don't really appreciate how they're losing ground to inflation. And there's a bit of a misconception. I almost view it as the inverse of compounding.
And do you think that that's a function that we've been in a disinflationary environment for the past kind of 30 years? And is the fact that you say that people have to wake up to it, is that because you think that we arrested that and we're headed the other way now?
Yeah, and I love Audible, and I used to just go for long walks listening to books. And if you kind of come out of World War II and sort of the birth of leverage and debt and the like, we just had this last 50, 60, 70 years where the world was not yet saturated, in terms of the return profile you could get for that incremental dollar of leverage. And we've kind of hit this point where it's just not the case anymore.
Okay.
At least it isn't right now. And yeah, I just see a lot of people haven't been exposed to these challenges. And I mean, if you asked a young person growing up in Turkey today who's seeing 60, 70% inflation every year, what's your chance of buying a house outside of your own country? Like, it's just been destroyed. So I think we've been a little immune to it because we live in a great country. But it's still hurting people left, right, and center. And yeah, I'd hate to be a young person trying to get a job, buying a house right now and getting ahead.
Got it. So now what question do you have for the next guest?
I think it's similar to that, though. To me, it's like, we know the concept of compounding is well understood. But that real return issue is the inverse of compounding is not well understood. The question I would ask is, how big of a factor, if any, does real returns factor into how you build a portfolio?
Oh, that's a great question. I like that a lot. Okay, Chris, at the end here, we're going to talk about Silver Crest. Tell us, this is your chance to plug the company. Tell us what you want about it. Why, the Silver Crest is the premier silver company that investors should have a look at.
Great. Thanks. I've got a lot more silver hair, having gone through, going from a small little piece of property to, raising the money, building it on time, on budget, cleaning up all of our debt, and actually having a lot of a big fat balance sheet. We've got no debt, $100 million of cash. That is a very enviable position. Over the last 3 years, the GDX has increased their net debt by 150%. The silver guys by, 250%. So that resilience that we've talked about, the ability to invest off cycle, to be opportunistic, to be patient, the fact that our asset is one of the lowest cost assets in the space, the fact that our balance sheet is where it is, gives us that ability. Even the ability to hold on to gold and silver was born from the fact that we have margins, we have choice. We're in an industry of price takers, and quite often people are having to sell their product at inopportune moments, and we don't have to. And we've collectively, with the management team and the board, agreed to buy back some shares, hold on to some gold. And if we can be opportunistic with either, M&A or buying another property or buying back our own shares in this cyclical time, we've been fortunate enough to get there. So again, I look at us as a long dated call option, given our ability to be resilient in a space right now where there's not many long dated call options. There's a lot of guys crossing their fingers for pricing to go up with, pretty bad balance sheets. So, I love the metal. I think not many people are long the metal. And I think the sort of performance of the miners has tainted the performance of the metal. I do think small amounts of capital coming back to the space are going to matter. And we're, liquid as far as a single asset goes. We provide that resiliency. And yeah, I think we're looking at risk management a little bit differently. And we're, hopefully going to find a lot more ounces as well.
So for those that are interested, give us the symbols where they trade.
We trade in Toronto under SIL. Yep. And for some crazy reason, the ticker SILV was still available on the New York Stock Exchange when we went to list there. So we got pretty lucky with those tickers.
So you got SIV. And for those that are interested, this website is silvercrestmetals.com. And I guess you have investor relations if anyone has any more questions, right?
Yep.
Terrific. Yep. Chris, it's been a real pleasure chatting with you and your kind of unique take on the mining industry. Thank you for your time.
Thanks for having me on. Appreciate it.
Take care, buddy.
Thank you. Cheers.
All right, Patrick, it's time for Talking Charts. What do you have for us this week?
Okay, well, listen, it's been a month since me and you chatted.
That's right.
Obviously, Cuppy held the fort.
With the Cuppy?
Yes. Yeah, of course you wouldn't listen, but we did. It was, and he did a great job of.
He always does a great job. He's always pitching. Entertaining. I just have to make sure that you don't end up putting on the tinfoil hats and going a little too far.
Well, we did. We did.
Okay.
Tinfoil, a little bit of Bitcoin and stuff like that.
All right.
I mean, the asset that should not be named anyway. So let's talk about the top three things that we were watching last week. And so we were asking whether oil was actually going through a bottoming process a couple of weeks ago. And while it's down today, it certainly is holding at the top end of its 3-month range. And with today's weakness, we'll put up the chart in a moment. I'm curious whether the buy on dip traders will keep it above $75 a barrel. Are you generally in the bullish tilt on oil?
Yeah, so I wrote it up. You can tell how much Patrick reads my stuff, but I definitely went long oil futures. I have a pal that keeps selling the oil puts on every single dip, and then just kind of when it goes back to the top of the range, he covers it. He's doing way better than me. That this is kind of still struggling with this thing that might be grinding higher, but it's been pretty disappointing for the bulls, I must say.
All right. Well, number 2, we were watching the breadth of the market. And you know what's interesting, Kev? In spite of NVIDIA's turn higher and obviously S&P 500 ripping higher, the breadth of the market isn't actually improving. I'm just going to actually here quickly show this one. This is the NASDAQ percentage of stocks above their 50-day moving average. And in spite of the Mag 7s all pretty much being listed on the NASDAQ, we have only 45% of NASDAQ stocks that are trending higher.
Yeah,
over 50% of NASDAQ stocks are in a downtrend. And so in spite of this huge rip, the rip is really not, a broad rally, and the breadth is not improving. So this really is about how far these Mag 7 stocks will go. I want to talk about that in greater detail when we get to actually pulling up some charts. But really, if NVIDIA can rip to 900 or something, of course, the indices are going to get dragged higher with this. But will the breadth return is a really interesting question. It certainly hasn't in the last 2 weeks.
All right, what was number 1 last week?
We're just looking at the inflation numbers, and they came in hot.
Oh, yeah. It was actually shocking. But you know what was even more shocking than the actual numbers was the reaction, meaning that we had what you'd expect in terms of the market quickly selling off, people freaking out about it, but it was a one-day affair. Kind of within 2 days, everyone had forgotten about it.
You know, and I think it's the nature of the beast, which is nobody cares about market risks until everyone cares at once. And I think that what happened there is everyone reacted, but then when everyone realized that the market is still behaving bullishly, then everyone's like, shit, I got to buy the dip. And quickly everyone got back onto the bandwagon. I think it's going to take us something a little bit more to crack this market. It's clearly these kind of news events are not doing it.
I'm going to push back a little, and I'm going to say that it actually has more to do with the fact that people are complacent about the return of inflation. Too many people are like you with your Gary Schilling posters above your bed and all believe that
Lacey Hunt.
Sorry, is it Lacey Hunt?
Yeah.
Okay, I get my deflationist confused. One is way more sexy than the other. Anyways, the point being that even with the kind of inflation surprising on the upside, the markets really still believes that this is not a long-term problem and that we're going to continue to have or at least put it this way, the surprises from the inflation won't continue. And this was just a one-off, and we'll just as quickly see a return to back down to 2%. Now I'm going to take the other side. I think inflation is going to continually surprise to the upside. And the only question is, does the market kind of realize that in a whoosh? Or like all of a sudden one day they just go, hey, wait, this wasn't, we're all expecting.
That's assuming you're going to be right, and you're not going to be right. So the thing is that you're just making a lot of assumptions. Listen, I get it that there has been a reinflation has started up again, or acceleration of inflation. And yeah, will it be a shocker if we see 4%? No, but there's no way we're going north of 5%. I'll make you a bet on that.
4%. That means, like, what do you think that the 10?
Well, we came off of 9%. No, but we came off of 9%, and when we were at 9%, the 10-year yield was at 5%. Like you're what are you going to go at 4%? And you think that the bonds are going to crash again? No way.
Well, I think it depends on whether the market believes that 4% is something that is going to continue. Because even when we were 9%, everyone was thinking that the recession was inevitable, and we were actually going to get a crash.
Yeah, but we do still have a recession coming, so I'd like to see how this plays out over the course of the year. Look, there's going to be an uptick in inflation. I'm still actually a buyer on dip on bonds. I'm on the other side of yours trade.
That's good. The world has returned to normal. I like it.
All right, let's talk about the top 3 things to watch over the next 2 weeks. So the first thing, we're going to watch the job numbers. Like, to me, I don't think they're going to be huge market movers, but those jobs numbers came in so hot that the question really is, was that a one-off? Was that just, or is it actually a new trend? And I think that we're going to have a much more normal jobs number come in this time around. What's your thoughts?
I think the jobs number are almost a non-event. Because
non-event is something I did say. I don't disagree with that. The thing is about the fact is, you think are they going to come in hot?
I think even if they do, I don't think it's an issue. Listen, if the hot inflation number didn't affect it, I don't know why a hot job number is going to affect it. Mm-hmm. Right? Like, ultimately, you're only worried about a hot job number because of a hot inflation number, but we already have a hot inflation number. And the market didn't care. So what does a hot job number mean?
I just think that the number may not have been accurately reflected. And then if we see normalization, then it was just a one-off if it comes back in line. But if it stays hot month after month after month.
What if it ends up being a surprise and there's actually more weakness than people think? Does the market, stock market like that?
No, I don't think so.
I don't know.
Well, I mean, okay. Well, let's talk about this because, this is a segue into number 2, which is global central bank monetary policy. And obviously we had the FOMC minutes just out, but we have the ECB coming out in a couple of weeks before we're on, and Bank of Canada and so on. Now, obviously, the question here, they're trying to obviously talk back the rate cut cycle. Obviously, with these kind of numbers, it would be foolish for them to rush into cutting. And obviously now everyone's backstepping, now everyone's thinking the first rate cut comes in June, but I even think it could be like somewhere in the third quarter. But ultimately, the question is that if the jobs numbers did come in weak, like you just suggested, well, then that could imply that maybe they will move in the second quarter. And that's I think what will be a lot of the questions associated with whether the jobs number comes weak or not. I don't think it's going to be weak. I think it's just not going to be hot like the last month on that. But by the way, so let's talk about the ECB.
Oh, sorry,
go for it. Oh, yeah, no, go.
You were going to talk about ECB. Go ahead.
All I was just going to say is in the end, is the ECB taking the cue from the Fed? There was a couple of articles I was reading where they were suggesting that the ECB is unlikely to cut interest rates before the Fed. But yet, I would argue that the European economy has been weaker than the U.S. economy. And therefore, they have a lot more room to start cutting first. What's your position?
Well,
there?
that's
Do you
exactly
think
what I was going to say, Patrick, is that everyone's sitting around waiting for the Fed to cut. And yeah, let's stop and think about the Fed. The U.S. economy is the strongest economy in the world. Why, therefore, do we think that the Fed is going to be the first to cut? It's ridiculous.
Absolutely. Canada and the ECB should be cutting first.
But our central banker here in Canada, the Tiff Macklem, how do I say it? Macklem? Anyways, regardless, he's the worst banker since Jean-Claude Trichet when he raised rates twice during the great financial crisis because he was worried about inflation. This guy is like Gordon Gekko says, if he owned a funeral parlor, no one would die because this turkey's brain dead. He's trying to be all tough and hawkish. In our economy here in Canada, we did less fiscal stimulus. Okay. We have a higher consumer debt load, and we also have more variable mortgages when it comes to the debt that's associated with consumers on their houses. Okay. But we should be going first. We should have never raised as fast, and we should be going first. And yet he's just kind of clueless. He's going to he's going to Thelma and Louise our economy.
I honestly think that global central bank independence is slowly disappearing as everyone really is taking cues from the Fed, which to your point, you think that they should be quite independent and they should act independently to what their economy needs. Yeah. But it's clearly that they're all waiting for the cue from the Fed to act.
Well, I would say that the only one that actually was willing to push back on the Fed was Japan. And Japan, you could argue that they're like in a recession, things aren't going well, but in a lot of ways, they're finally combating and getting out of their multi-decade disinflationary / deflationary funk that they've been in.
Yeah.
And they are being really slow to allow the market to kind of push them into tightening. And ultimately, I think it's going to be better for their economy. The longer they stay loose, and the longer their currency stays down here at this stupid cheap price, the better.
And about to get cheaper.
Well, could be. I listen, but ultimately that just makes their economy all the stronger. They are stealing. They're going to steal growth from everywhere.
Right.
Anyway,
so I want to talk about that chart in a second, actually, because I think that's worth talking about. But number one, obviously we'll circle back to inflation because we'll have that core PCE price index. Is there anything? I mean, we obviously talked about inflation a second ago, but is there anything specific that you're looking for in this number?
Well, this is the one that matters. This is the one the Fed cares about. So, yes, the CPI is the one everyone trades and everything's based upon, but this is the one that really matters for the Fed. Rightly or wrongly, this is the whole enchilada. This is what you should be focused on because it's what the Fed is. And I don't have a view on it, but I'm not even sure if I told you, but there's going to, again, surprise to the upside, whether you could say anything except for the first hour, what the market reaction is going to be.
Yeah. Yeah. All right. Let's talk some charts, bud. Okay. So let's start off with this S&P rip. And obviously, we can't analyze this S&P rip without talking about the Mag 7s. That's really down to Mag 4s. really. Like, I mean, NVIDIA obviously is the general that is leading the way. And not only has it been parabolic through start of January and February, but now on this earnings, tacking on a couple $100 billion of market cap in just a couple days, this thing is just on fire. There's all sorts of technical measured moves that even suggest that it can even approach 900, which would get a lot of the excitement considering there's a ridiculous amount of open interest on calls up in the $900 area. And I wonder whether that will actually have some sort of a gamma effect pulling it there. Do you think that that huge open interest of calls up there is going to influence it?
Well, we can assume, let's assume that the market makers are short those and the clients are buying them, which in the past, you might not assume that. Like if it was index, you'd actually probably assume the market makers were long because usually people fund their purchases through selling calls. But in this case, I actually feel like more than likely that's actually a net long position from the clients and the market makers are short. And so having said that, Patrick, the closer it gets, obviously the more likely is that, they're going to be short gamma and they're going to kind of exacerbate any moves.
Exactly.
And maybe that's in fact why we've had such a wild run so far. But
I think so. I think you're right. The interesting part is that this has got the that parabolic acceleration of trend. We've done this numerous times over the years where we talked about when something reaches bubble phases. I mean, I remember when Tesla was in that parabolic phase back a few years ago, we had the same type of a chart drawn on. What's interesting here is that when it gets into this kind of bubble phase, it's a pretty tricky thing to try to predict where the top will come in, because this is when things get stupid and you can't use any rational logic for kind of sizing up bubble momentum. But was it Jim Rogers that always said, like, in the last couple of days of a move is where the biggest blow-offs occur?
I think he was the one that focused about gold, and he had the line. He said, I sold gold, like this was back when it was moved from 400 to 800, which was a big move back in the, whenever, 70s, or it wouldn't be 80s, early 80s. And he says, I sold gold kind of within 2 days of the top. The trouble was it was $300 too early, meaning that the last bit was really, really exponential moves. But you know what I think is even a better line for kind of understanding this sort of behavior is Bob Farrell, that legendary Merrill Lynch strategist. I believe he said, exponential, rapidly rising or falling markets usually go farther than you think, but they do not correct by going sideways.
Yes. And this is the thing, right? Ultimately, this is going to deeply mean revert. Often we call it the Eiffel Tower formation.
Well, it's been a while since we've been talking about the Eiffel Tower formation.
Yeah, but this one could happen. But the question is, does the peak of the Eiffel Tower come at $1,000, right? Like there's at this moment, trying to predict when NVIDIA is going to stop this run is sort of like standing on the train tracks of a train traveling 100 miles an hour, and you predicting that this is exactly where it's going to stop, and it's a dangerous game, and ultimately it's going to just keep going higher until it simply runs out of marginal buyers. It's just going to have to continue. Yeah, it's gonna when the top comes in, it's going to give back at minimum half of the gains it made.
So what but it moved from 500. So let's say it goes to 500 to 900, $400. So
I would argue. Oh no, I would argue that you have to measure it from the 2022 low. It could easily. I mean, it started at $100, and so if it goes to 1,000, it could easily go from 1,000 back to 500.
Oh, okay, that's what you're looking for.
No, but it's yes.
Yeah,
that's I would say when
you don't know if it's going to 900 or 1,000 or even 1,200.
You don't know, but when it does, it's going to give at least half of the gains back in the thing. And so you're playing a game of musical chairs, and those people that are long, well, stay long. It's going to go higher. It's like who was that made that comment that when I see a bubble, I buy
George
it?
Soros.
Was it Stanley?
No, Stanley Druckenmiller talked about it, but it was really George Soros that did it. He would say, when I see a bubble forming, I rush in to buy.
Exactly. And so those people that are long NVIDIA, well, you stay long. I mean, you try to capture as much of the move as possible, but it's a game of musical chairs. You, at some point, have to turn your paper profits to real profits. Otherwise, it's not real. And so enjoy the ride for now. It's probably going higher. But the point is that this stock, and let's just talk about the others like Amazon, which made that gap higher. That flagging formation looks like it's about to attempt to break out to $185. Meta continues to plug higher, making higher highs, could easily be, 5 to 525 on the upside. So, and even Microsoft is trying to turn up. We'll see whether it can muster up. This is sort of the more neutral of them. But the point is, it used to be a Mag 7, but Apple, Google, and Tesla have dragged their heels. They're no longer kind of contributing to pushing the index higher. And so you have really a basket of stocks that are down to, 4 or 5 stocks. That obviously there's Lilly has been a huge contributor. In my ignorance, I didn't realize the market capitalization of Lilly, but Lilly is a stone throw away from $1 trillion cap.
It's a big performer.
It's like the 8th largest company in the
way. Like that's one of his big kind of quiet longs that nobody's really talking about. Everyone's focused on Nvidia, but meanwhile, Lilly's like a rock star.
Oh, it's been rock starring, but then obviously at this kind of a market capitalization, it's certainly contributing to the index as well, right? Point is that there's these 4 or 5 kind of names that are doing all of the work, and so now the S&P 500 is plugging away. But what I find really interesting on this chart, Kev, is that the S&P broke to a higher high, and the Nasdaq still didn't.
Yes. I noticed that as well the other day, that it was
right?
Like the NASDAQ is not leading anymore, even though it's kind of ironic because the stock that's leading is all NASDAQ type stocks.
Mm-hmm.
What do you
And
make
it goes
of that?
back to the breadth. No, it goes back to the breadth. The vast majority, or more than half of NASDAQ stocks are downtrending, which is that if you're not in a few of these major growth names that are really working, then you're not participating. And so then maybe that divergence is just a reflection of that breadth deterioration. That's, I don't have any other explanation. The other thing to note here is the Russell really hasn't been able to turn back up while the rest of the markets have. So again, you have a scenario where this is really just a handful of stocks doing all the work. And if in this final bubble phase, you have the NVIDIA and all these other stocks make these rips, and maybe the S&P goes to 5,200, right? Like there's room for the indices to continue to edge a little bit higher while these other stocks finish the moves, and then when obviously the largest stocks, those mega cap ones, finally run out of momentum. I like to think of it like the fuel in a rocket being shot up into the sky. Ultimately, when the fuel burns out, gravity grabs it and drags it back down to Earth, and that's inevitably going to happen. It's just how much fuel's in the rocket and how high will it go before that happens, and that will probably be the key turn point in the indices. And it might be weeks away. I actually think it's a very good chance it happens before the end of March. These parabolic moves, while the price on the upside is unknown, it's the fact that it accelerates at such a fast pace that it tends to be constrained by time. So the idea that it would last several months is not likely. It's likely the blow off is going to happen within weeks. If not a month, and then so we probably may be correcting by the March OPEX.
I hope so.
Why all your March expirations?
Yeah, no. I'm just fed up with the market going up on 4 stocks.
Yeah. It's overdue. Anyway, the dollar index. Let's talk about the dollar. A little bit of a pullback. But I still think the dollar's in a primary trend. But it's interesting because it was a very oversold euro that spurred the reaction in the dollar. And we got up towards 109, but that's a typical retracement. So, in the way that I approach the markets is the ebb and flow. So you're going to inevitably, after a sell-off, get a 50% retracement. So a move back to 109, 109 and a half would be normal, but will be really interesting, particularly when we get to the ECB, whether or not the euro begins to weaken again and rolls over, because this will really decide it. We obviously have some different kind of momentum in different cross-currency pairs, particularly the US dollar yen, which we were referencing it earlier, just continues to be incredibly strong. I wouldn't know who would be foolish enough to own the yen.
Yeah,
do you know anyone?
That
Some
actually
idiot would
believes
be.
that the value of the thing matters. It's
like,
not just
who uses fundamentals to invest. Like, come on, that's so like 1970s, man.
By the way, I was looking the other day. I included in my chart pack that I send out at night the Mexican Japanese total return kind of index, meaning like what you'd get if you were long Mexico, short Japan. It looks like an AI stock. It's been an absolutely fantastic return. Because like even if you pull up just Mexico, Japan, like if you just do the cross rate, you have to actually also incorporate the fact that Mexico has high rates and Japan is still really low. So it's even better than the chart, than the cash chart looks like.
Right.
Can you do that? Can you pull up Mexico, Japan?
Yeah. You want MXN over JPY?
Yeah. Go like a little, like, see, there's the problem. It doesn't look as good as it actually is. It's better looking than that.
Right.
Because
but I mean, still, since 2020, this thing is almost double.
Yeah. It's just been
like for a currency pair to double, it's like, that's insane.
Like sometimes they double, but the reality is that there's a carry going the other way. So it's not really as good as it looks. In this case, it's better than it looks. It's been an absolute fantastic trade. That's the real question, though, Patrick, is how much kind of is the Japanese yen being used as a funding currency? Like how many people are out there with that trade on?
Yeah. Oh, you know what? Okay, listen, I'm a trader. At some point, every one of these trends will change. And the farther it goes and the cheaper the yen gets, the more violent it will be inevitably when it turns. But I just don't see that at this moment in the cycle why the U.S. dollar should turn at this moment from an intermarket perspective. I think it's one of those things where just like your bearish bond call in 2017, 18 to 2019 and 2020, you were 3-4 years early and ended up being spectacularly right. I think this is the same thing for you with the U.S. dollar yen, and you got the idea right. It's just the timing. I think I would not be shocked if we're in September, October still with you saying the exact same thing.
Yeah. Listen, I've been wrong. So I'm not going to.
No, it's not about wrong. You're just early. In the markets, we never say we're wrong. We're just early. And you're just early to the trade.
It's the same thing.
Oh, no. You can't do that.
Like, there's just no doubt about it. I've been wrong on it.
All right. Let's move on. I won't talk about Bitcoin. So let's just go to gold, the other physical currency. The interesting thing is that we got a bounce. And it's actually coming to what I think is an important level. So as an example, after this pullback in gold, you got the 50% retracement on the bounce. And that's a very typical ebb and flow movement. And so we all got another leg lower in gold, came to the round number of 2,000, and now we got a bounce, which is exactly right by its 50% retracement at this 2,050 level. So if it does what it did back in January, it will put in a short-term high and trade right back to 2,000 on the downside. But this is actually where you can take that nice thick crayon and just draw a line up along the these highs, and it just conveniently lines up with that same 2050 area where the 50% retracement is. And this is, I think, an important moment. Like this is going to determine whether gold bulls want to do something now, or whether this thing is going to stay in a trade range muddle for another couple months. So it's a key breakout point. I don't want to get bullish yet, but this is actually kind of a pivot level where things will start to really improve on the chart if it can beat these levels.
Yeah, you know what, Patrick, as we're recording this, it's Friday at 1:45. See, like, gold's actually closing strong, even though the dollar's like, there's no real reason for it to be closing so strong.
Yeah.
Anyways, Patrick, you know how I feel about gold. I think that everyone's sitting around looking at rates, looking at the dollar, and they're missing the bigger picture, which is that the fact that the
central banks are buying.
Central banks are buying. They're the true setter of the price, and that's all that matters. And I think that they're just going to be on the bid forever.
And when will the gold miners start to give a shit?
Well, so that one is a lot more difficult. And
because right now this is about as depressed as it gets. There was that headline that Stanley put on a position in Newmont. There's all sorts of like value guys slowly poking around, buying these, but this is an awful chart. Okay, can it double bottom? Can it find a support line here and turn? Sure, but is there any evidence that it has? Absolutely not. And it's been a very ugly downtrend in these kind of stocks, but it'll be a really interesting moment to see whether or not the gold miners turn here. Like while gold GDX is right along its lows, there's these other stocks like Newmont missing on its earnings, like brutal. Like it's such an ugly chart. And you know, I love this stock and I hate the chart. It's the worst combination. It's like, I have to patiently wait until this thing shows some sort of a bullish pulse. But you know, it's a very, very ugly chart on the downside, and these gold miners are getting zero attention, zero love, and they're just being heavily sold.
I'm not going to disagree. I got no pushback, baby.
Okay, so let's talk crude oil briefly. Obviously, you were talking about these little dips and idea of selling puts into them. I love that idea. In fact, I don't do short-term put writing that way, but I have a longer dated put in here. But it's going to be interesting. I love these kind of sell-offs like we got today. Not because, when you're long, it's nice to be down $2, but what's most important when you're trying to read the tape and understand whether the trend is your friend is when you get these kind of $2-3 pullbacks, do the buy on dip traders show up? Because if a stock is being properly accumulated, or in this case a future, and you generally see bullish price action, then every these types of $2-3 drops happen, you should see them immediately get bought on dip, and this thing should be back at $78-$79 by middle of next week. So these kind of things are important tests for me. If we see buy on dip traders come in before $75 and trade it right back to the high, I'm going to get that much more bullish that this thing is going to finally break out above that 78, 79 level.
Oh, from your lips to God's ears.
Anyway, let's talk about the Widowmaker.
Oh, nat gas?
How ugly has this been? This is the March contract.
It's funny.
But you know what? It's interesting because from the rules of symmetry, the measure moved around this $1.50 area is the end of a measure move. So there is a very reasonable chance we might see the beginning of a bottoming formation. But the thing is there's still nothing stopping this thing from wiping another 10-15 cents and staying in a 1 month trade range down along here before it rolls forward into the April or May contracts. But at some point here, I think the selling is going to start to base. That doesn't make it immediately a buying opportunity, but because you want to actually see when some sort of bullish price action is starting, and there's no sign of that. But it's been ugly. But I think that this is almost over. I think the bottom is close.
I'm just looking, Patrick, at the Boyle, which is the is it 2 times levered nat gas future?
Yeah.
Or sorry, ETF. And I was looking at it, wondering if they've been increasing the size of it as it's gone down, meaning that if people keep just buying more and more, and they have. It's gone from how many million shares?
It's down 66% in 43 days.
In November last year, just like 4 months ago, there was 11 million shares outstanding. Okay. There was 160 million shares outstanding a week ago. No.
Unbelievable.
40 million. Sorry, I got my scale wrong. Sorry, 40 million. So it's gone from 11 to 40. So it's, quadrupled. So yes, it's gone down a lot.
Okay, but on a capitalization, it's gone down because
fair enough, but it's actually gone. But what I was worried about was it's gone down, and therefore their size of their position is also going down. It's not, because they keep buying more. So what this?
Okay, but when was it 11 million?
11 million. It was 11 million, and the ETF was $67.
Okay, so basically, it is at 20% of its value, right?
Right.
25% of its value, and you saw the amount increase threefold. So basically, it's the same capitalization. They just
right. But the point being that means there's still like this monster actual futures position out there. Like, let me just look and see how many shares these guys own, or how many futures they're long. Because if we were to get a move off the bottom, now that the actual commodity is so low price, like it's 63,000 shares, or 63,000 contracts they're long. So pull up the net gas. Okay.
The gas contract.
So the thing is,
the March one.
Yeah. What are these guys long? They're long these actually, but it doesn't matter. So the
here's the
280 to $3 in the past was a lot less move as a percentage from 180 to $2. So as it goes down in price, it increases the chance that when it finally does get a move up, it'll be all the more violent by the fact that this boil is so large. Because don't forget, these guys need to hedge at the close every day to make sure that they replicate that 2 times leverage. Anyways, be careful of this thing. Even though it feels terrible and it's awful looking right now, I could easily see a situation where if there was a change in the fundamentals, we could have a situation where this boil actually caused the move to be outsized.
It's possible. You know what? I continue to watch that UNL ETF, which is the 12-month natural gas fund, and it plays the strip, and it's obviously been killed as well. But it becomes a easier way to deal with the fact that there's this ridiculous contango. Like, I mean, winter gas is still nat gas is still $3 plus. Like, so I mean, you're basically here in the spring, summer gas, talking, where it's half of the value. So there's this huge contango that's going to be rolled into, if it's at least if the winter gas stays up there, and so at some point,
doesn't this
being
own the
long
whole year though?
Yeah, that's what I mean. This is why this is interesting to me, because you're almost hedging out that versus when you're in the UNG or the boil, you got to deal with the fact that you're rolling up the term structure.
Right, but let me just look, because 1 year to the next might have an actual like a difference. Let me just look here. Yeah, no, this year is trading at way less than the next year.
Yeah.
Oh, that is.
Oh, yeah. No, this is a collapse of the front of the curve. The spot price is what collapsed. Like, if you look out the term structure farther out, it's still all in much more reasonable levels. This is clearly some sort of supply.
It's a weather
glut.
The reality is
you could call it weather, but it could be a huge supply glut from the fact that they're producing so much of the nat gas.
You've abandoned the North America, so you don't know. But like today in Toronto, it's 10 degrees.
Fair enough.
It's hot. Like what is it in Portugal? I bet you it's not much warmer there.
Oh no, it's like 19 degrees here.
Well, it is warmer. But
I was suntanning earlier. No,
my eyes. Okay, for Patrick out there, just the thought of you out there suntanning. Okay.
Oh yeah. I just wanted to just touch on uranium, and then we can wrap this part up. What's interesting is obviously uranium is trading at the spot is anyway at $98, but the U.UN has just really started to get hammered, and I talked about this with my members, and I even with I think I mentioned it with Cuppy, I can't remember now. But we were due for a correction, but this is an accelerated move on the closed-end fund relative to spot. I mean, I last time I checked, I don't know what the number is now. Maybe you have it more convenient, but is it still at about 11%, or is it more 12.5% discount?
I think it's going to record wides.
Really?
Yep. I'm actually.
Why you think some margin calls are coming in here? And
the reality is that Sprott closed the door on the idea that they would ever, sell the underlying to buy back the shares. So there's going to be no way that the mechanism ever kind of.
Yeah, but don't you think it could mean revert though? Like if it goes to record wide, wouldn't it eventually close?
Well, no. So I think that 10% is going to be the new normal on this thing.
Really?
Yeah, I think it's going to be 10% discount.
I don't. I think it's 10%. If uranium stays flat, then I could see that. But if we get into a scenario where spot price of uranium starts ripping 120, 140 and goes cuppy Kool-Aid to the upside, everyone's going to be grabbing at this again, and maybe this thing will actually sell even temporarily at a premium when the FOMO kicks in.
I disagree.
I
First
think,
of all, it can't sell at a premium because the moment it sells at a premium, Sprott is going to issue as many shares as they can and increase the asset size. So it is stopped out on the upside. So that's not going to happen.
Fair enough.
Right? Like the only reason it would sell at a premium.
I said temporary.
Well, the only reason it would sell at a premium is that they were no longer, for some reason, they weren't able to buy anymore. Meaning that they weren't able to go out and buy the underlying. And so let's say the government tomorrow said, oh, you're not allowed to actually trade this anymore. Then I could see it trading at a premium. But in the current environment, I don't think it ever goes to a premium because the moment it goes to a premium, Sprott issues everything they can and they go and buy more pounds of uranium. So you got to think about it in terms of when you're thinking about the NAV, 0 is the upside. Like that is where it stops. Okay.
Right.
Then you got to think about when people need to get out. What's where is, like, if you don't have an environment where people want to own it and you need to find new buyers to get people out. That's why I think you're going to get spikes to 25%. Like I think that we will get spikes to 25% discount.
Wow.
Yeah. Listen, and this is we're just purely talking about the discount or premium to NAV. And like Cuppy rightfully says, I don't care. I need to own this because this thing's going to double, triple, or whatever he thinks it's going to. And I get that. He doesn't like I shouldn't put words in his mouth. But for the real bulls, they're like, it doesn't matter. So you know what? Instead of me getting out at a 5% discount, I'm going to get out at a 10% discount. I'm going to live with that because there's no other way to get this exposure to this pure underlying uranium. But anyways, I'm actually, Patrick, I think that this trade is going to come unwound in the next little while, and that it's going to get worse.
Well, clearly, it's someone who has been riding momentum is now being a very aggressive seller. To sell it at this pace relative to where spot prices, it means that there's just a supply. Somebody is hitting the bid and unloading whatever they can at these levels. I think actually, whether you're right that it trades at a 20% discount at some point, I think right now on the short term in this $27, $28 area, it's a very interesting place to go long for a bounce back into the low 30s. Anyway, let's see what that support line holds. Kev, I want to just touch on two quick indices. We were going to stop, but I just realized we didn't talk about this Nikkei.
Love it. It's so good.
Oh, you love it.
It's such a sexy chart. Nobody cares.
Oh no, I've been talking about it quite a bit, but I'll tell you, my upper target when it broke out at 36,000, my upper target was this 39 to 40,000, and so sort of the way uranium kind of hit its short-term high and then came back. It doesn't make me bearish Nikkei. I don't think it's like Nikkei is going to go into a bear market or something, but I think that we're going to hit some sort of a swing high in here where it's going to start consolidating. And so I actually think this round number near 39,40,000 is a level to watch for some resistance to form.
You could be right. It's gone so far so fast.
Well, yeah, and it's not about being bearish. I'm not being bearish. I don't think it's like going under 36,000 or something. It's just gonna at some point have to backfill a little bit. But it's so interesting is that that's happened the same time as this Euro stock, which is I still can't wrap my head around how bullish the European market is. And it's like obviously a weaker euro's helping a bit, but this is insane. This is making the chart look, both Nikkei and Euro stock are distinctly more bullish than U.S. equity indices. I mean, you have obviously Nvidia and individual stocks are running hotter, but this is insane momentum for the other developed markets. But similarly, I had an upper target of around this 4,900 on the upside. So I think it'll be interesting whether both the Nikkei and the Euro stock start running out of momentum in the next week or two and start some sort of a backfilling correction after having such an amazing run on the upside.
Isn't the Euro stocks a function of these high-end consumer companies?
Yeah, I mean, one time we could go through all the top holdings, but obviously they don't have that much weighting into the tech space. So obviously pharma and other types of...
Look at this, Patrick. Ferrari's in this thing. Like Ferrari, that's like, how is that in their like Euro stocks 50?
It's a nice car. It's a nice car.
Whatever. Like
but that's what Tesla people do. It's like, it's a nice car. Well, the Ferrari's a nice car. Why can't it be?
I guess so. Tesla's going to change the world, though. That guy's a genius, you know? No, honestly, we're so lucky to be living in the same time as him.
Can you stop?
Oh, and I'm so happy about all that he's so giving.
Oh my God. Your sarcasm is the worst. Like, you know what? Like literally just stop. Okay. So, that's it. But now it's your turn.
Okay. Yeah.
We've done mine. So now we're going to do Krayons with Kev. So, what do you want to look at? Are we looking at Tesla now? Because you started
look at XBI. And one of the things that I want to say is that this isn't actually me. Every now and then, like you cheat on me on the podcast.
Okay. Who'd you cheat with?
I cheat on you with my technical analysis, dudes. Okay, let me grab it here.
Really?
Yeah, I listen to every now and then. I see what they say, and this one I came across.
But you don't listen to me.
I listen to you. I just don't tell anyone that I listen to you. That's the only difference. I won't admit it in public.
And I'll never admit to reading your newsletter either. Yeah. So don't worry.
So the guys at All Star Charts, which I actually really like, and you know what, you should interview them because I can't do it. You guys talk gibberish to me. It all makes no sense.
Okay,
but they highlighted today XBI, and I must say when they showed me this chart, I was like, oh, that kind of stirred me in my loins there. It was a good looking chart. So let's have a look at it. Let's pull it up and.
By the way, we can also at the same time look at the IBB because it's interesting because they're both biotech ETFs, but the shares that compose of them are very different. Like the IBB is much more in those mega cap kind of Amgens, Biogens, while the XBI is much more of the kind of mid to larger cap names, but not so heavily weighted into those big mega caps. But both of them actually have a very similar chart. But anyway, make your analysis.
This is kind of, I'm stealing the All Star Charts one, but I must say I like it. So let's pull up like a 3-year chart. Can you do that?
Sure. I'm going to put like a weekly chart on. So
there we go. So you know me. I'm a big believer in there's no such thing as quadruple or quintuple tops. To me, it looks like this thing was bumping up against, $90 or wherever you want to draw your thick crayon, maybe 91. And bumped. And then it had this big scare into October. Looked like, sucked in everyone thinking this thing's going lower. It's actually been super strong, pushed up above it. It's broken out. To me, it looks like this thing's headed to $130.
Okay. So, first of all, there's no denying that it broke out of its multi-week flagging formation, which typically is a sign of a bull breakout. And therefore, it is showing a bull trend and accumulation. Nothing I would push back on that. But just because it cleared its 2023 high, it doesn't get me excited, because I put in a number of highs in this, mid 90s range, going all the way back to 2022. And so, if the whole NASDAQ was to turn, and you saw the breadth of the broader NASDAQ has been relatively poor, which is where most of these biotech companies are listed. If the whole NASDAQ turns, this could be a prairie dog. Now that's only speculation, which isn't, but there's no evidence of a prairie dog. All we have is a break to a higher high, which usually I personally always give the bulls the benefit of the doubt. But really, if there was an immediate pullback here, I'd want to see it, around $92 immediately get bought on and traded right back toward the highs. The worst possible thing, if it was marked a prairie dog with a drop under $90, then immediately you have to bail out on this trade. But it is a bullish trend.
I'm a buyer. I like it. I like that chart. I'm a buyer. I don't care.
All right. So let's move on to No Stupid Questions. This is where we're going to invite Danny on to read us some questions. All right, Danny, save the day, buddy.
Hey, Kevin and Patrick. Hope you guys are doing awesome in the wild world of markets. First off, I got to say, loving the podcast. Here's my burning question. Now, I've been scratching my head over this conundrum. Why on earth are those 30-year interest rates playing limbo and dropping like it's hot? I get the short-term dance with the Fed and all, but the long end? It took a 120 basis point nosedive just because inflation's taking a nap. I mean, come on. Sure, the front end's doing the cha-cha with the Fed's moves, but the back end doing the moonwalk on declining inflation news? Growth's flexing its muscles. Short-term rates are chill. Recession risks are doing the limbo low. Why the dramatic fall in the 30-year rates? Kevin, as the all-time bond bear, I bet you get some spicy insights on this. And Patrick, the thick crayon god of technical wizardry, can you sprinkle some of that crayon magic to decode this for us? Looking forward to your thoughts and keeping the laughs and insights coming on Market Huddle. Cheers, Amir from Geneva.
Okay, Patrick, do you want to take a first shot at it?
No.
Okay, I will explain why I think bonds are up over the past little while. First of all, we have to remember that going into, the September FOMC meeting, we had kind of a change in attitude. And at that meeting, that was one of the meetings where everyone was expecting the Fed to pause, and they didn't. And what they did was they actually provided us their SEP, and they showed that rates would be higher later. And when that happened, the bond market went no bid, and we went from 4 to 5.25 in the space of a month and a half or something like that. And at that point, if you remember, we had the kind of the pivot from the Fed, meaning that they said, okay, we thought we were going to have to raise rates a lot, but the reality is that the back end backing up so much, rising in yield, is doing the job for us. So therefore, we don't need to raise rates as much. So that was in essence the start of the pivot, / pause. And but we have to kind of put ourselves back into that point where we think to what the market was doing. And at that point, people were so bearish on bonds that even I had to fade it and was long. Remember how dirty I felt, Patrick?
Oh, you were. It was.
Yeah, and
you had to go take a shower.
Yeah, because I was like, I can't believe I'm saying this, but I'm buying bonds here at 5 and 5.25 because all these people are so bearish, and it was just so lopsidedly bearish. And when people were lecturing me about term premium, like I'd never heard of it, and they didn't really even understand what it was, I was just like, okay, we have hit this point of just kind of maximum pessimism in terms of the bond market. And so we had this kind of switch, and basically everyone went from really short to saying, oh my God, the Fed's pivoting. It's not as bad as we thought. And it was just a reflexive kind of buying back of their bond positions. And so when I look at the last few months, I don't really say that the market action has been that great. What I say is that the market action was pretty stupid in what was it? August, September, October. That's how I feel. So to me, I feel like we started in September at 4.25, and we're still at 4.25.
So I in a bigger picture, I'm going to say something that you're probably going to laugh at, but I am in a much bigger picture. I think that this is just the kind of the echo or the waves in the post-COVID thing. So in COVID, they shut down the economy. They dumped a ridiculous amount of credit into the system to kind of keep the economy from collapsing. They did a great job on preventing it becoming a recession depression because of what they did. But the massive amount of credit they injected in the system was a huge contributor to the massive inflation surge. And they had to basically cool everything off with record interest rate hikes, which basically created one of the greatest bond bear markets that we have seen in a century. This happened, but now that credit has been dried out. And the thing is that while we will see these little upticks in inflation, I think at least for this leg of the bond bear market, it's over. Now, could we be in a secular bond bear market where interest rates stay high for the next 10 years? Maybe. But I think right now, last year's low, which is the high in yields, but the low in bonds, is going to hold for a little bit, like a year or two. I think that this leg of the bond bear market is over, and I still think that there's going to be bouncing and retracements in the bond market. So I'm in a bit of a different situation. I think it's all a byproduct of that whole COVID cycle.
Sorry, I threw up in my mouth a little there.
Right. Let's read the next question.
Hey guys, I do a lot of long, short kinds of trades, and sometimes I short a 2x that rolls daily from an M1 to M2 futures contract. It has a higher borrow cost than shorting a more traditional product, but as best as I can do the math, I can sometimes make more through shorting something that loses value due to contango, even if it has a higher borrow cost. But I've started to wonder when a product like this loses most of its value through contango. Is it when the market rips up or down, or just chops up and down? I'm guessing the chop is what turbocharges that contango, but I wanted to check with you guys. Also, anything else that you can say about contango and a trade like this would be appreciated. Do you ever see contango so bad that you could just short a 2x or 3x versus the underlying asset and walk away with a profit? Or is it one of those trades that went away when computers started talking to each other? Thanks as always. Mike.
So listen, Kev, what it comes down to is he's asking about whether it's the chop or the contango that's going to eat him on his 2 to 3 time leveraged.
Well, so the 2 to 3 times leverage is a much different kind of decay, and people need to understand that is it's different than an option decay. And the reason it's different than option decay is it depends on the direction of the path, meaning that if you have like a day where it goes up 2%, down 1%, up 2%, down 1%, up 2%, down 1%, that's a lot different than a day that goes up. What does that work out to? 1% a day, or no, 0.5% a day. If it goes up 0.5% a day each and every day, then you don't get that kind of losing of the 2 times or the 3 times lever ETF. And really what you should do is you should sit down, and if you want to kind of understand this, go look at how what an ETF needs to do to make sure that they have 2 or 3 times leverage for the next day. And then if you walk through the series of kind of transactions that it'll do, or even just watch what they do in terms of pull up their holdings every day, you'll see the transactions they're doing, and then you'll understand better how they make or lose money. But theoretically, everyone always assumes that the chop is going to hurt you on that 2 times or 3 times leverage. If it actually only went one way and it didn't go if there was no corrections along the way, you'd actually be better off in that because you'd be pyramiding in a positive way.
Right. Right. But ultimately, your leverage to, if something like nat gas, where you're rolling up the term structure on such a steep contango and you're 2-3 times leveraged, that could be quite painful.
Well, that is true. And no doubt that the contango also is an issue. But on top of that, more importantly, is this idea of the path of the double of the security if you're using an ETF with leverage. Go and make sure that you kind of go do it or go look for some articles on it because there's lots and they'll explain. And once you see it in action and understand it, you'll realize why that is such a dangerous strategy.
All right. So let's move on.
When looking at simple moving averages, 50-day or 200-day, what time frame do you use? For example, when I pull up a chart of SPOT, if I look at the 1-year chart, it would appear the price is above both SMAs. However, if I change the time frame to 6 months, it shows the price has dropped below the 50-day.
So, Kev, when I'm looking at this chart, what clearly our listener is just experiencing is that whatever charting service, when he's changing his time frame, it's changing it from, let's say, a weekly chart to a daily chart, which you can clearly see just by the candles and looking at what was happening. So a 50-day and a 200-day moving average simply can't change by changing it from a 1 year to a 6 month because it's still calculating the same 50-day closes and dividing it through to determine where that line is. So clearly this was a change from where each candle is representing either a weekly candle versus a daily candle, and that clearly must be happening for this person when they're changing it on their charts.
Around an hour and 37 minutes into episode 231, you said some really mean things about the VIX. But not only were you mean to the VIX, you were mean to yourself. You said, in regard to going long to the VIX, quote, "It's a terrible trade and I hate myself and I feel dirty doing it." Patrick is a good friend and he tried to console you, but you just weren't having it. You shook off his suggestions to go long a straddle. What is the difference between the trades? What is the problem with the VIX? I say this as a guy whose only working trade last week was an in-the-money VIX call, though I nervously took profits early because I've been burnt by it many times.
This was where we talked about the VIX a couple episodes ago, Kev.
Is that me saying I hate myself and I feel dirty doing it?
Yeah. Yes. Going long thing. And I was commenting that I preferred putting it on with the straddle type thing. And so his question,
okay,
what's the difference in the trades? Okay, so let's talk about it.
The VIX technically is I think they call it a variance swap because it's not the same as a straddle in that the straddle represents the volatility or move from the current, whatever the price of the straddle is. So let's say you did an at the money straddle. So it would move, the volatility would be based upon the volatility around that strike. Whereas the VIX represents all the strikes. So therefore it ends up being a different kind of calculation and different behavior than owning a straddle. Like I know a lot of people say, but they're both long volatility, but there is some change of it.
Absolutely, because as it's trading along the skew, you're going to be stuck at a certain strike price within there. So you might have a big steepening of the skew farther out, and you see a big vol spike out of the monies, but your at the money straddle is simply not moving at the same pace.
Right. Well, like technically, think about it. If you're long a straddle, let's say you're long a straddle of a security that's at 100. And
okay, well, actually, let's just take a moment and explain a straddle. So the straddle is the simultaneous purchase of a call option and the purchase of a put option at the exact same strike and to the same expiration. Otherwise, it's calendared in some way. So you're choosing the same strike and the same expiration, and the idea is you're long delta on the one, short delta on the other. So you're actually delta neutral, and it's the purest way of being long Vega, which is long volatility, because you're long volatility on both the call and the put. So volatility expands, both options benefit. And so a lot of people that trade the straddle are trying to benefit from vol expansion.
Okay, but let's imagine that underlying security goes from 100 to 90. Okay, what'll happen is, yes, you'll make money on the straddle on the delta move, but now your gamma is a lot less, and even your vega is a lot less, because the reality is that it's way out of the money. And where a VIX is different is that the VIX takes the new at the money and weights that one as the largest component. And that's in essence what's difference between owning a straddle and owning the VIX, which is a variance type swap. If I've got that right in terms of terminology. But it is, for all intents and purposes, basically the same trade. And it really only gets kind of it only really matters once you move away from the strike. And if that's the case, chances are you've made a lot of money on your straddle if it moves far enough.
Right.
Right. And so that's like it is really I like doing the VIX just because the upside, if something really goes wrong, is much higher than have
you ever considered putting it on as a debit spread on the VIX options?
I just trade the futures. I'd rather just own the futures. And then like you're buying options on options, like it's just getting kind of.
Yeah, I get the derivative of the derivative of the derivative.
And I know, listen, there's some really smart guys, like Mr. 50 Cent is one of the smartest guys out there, uses that trade in terms of where he goes and buys options on it, on the VIX as a way to hedge a portion of his book. When those things work, it works spectacularly well, but it works so rarely that I'd rather have a kind of a trade where I can trade it around more, and I'm not just trying to hedge a really huge spike.
There you go. All right, so Danny, hop on here. Where can listeners submit their questions?
If you have any questions for Kevin and Patrick, you can submit your questions to nostupidquestions@markethuddle.com.
Fantastic. All right, Kev, take us to the close, buddy.
Thanks for tuning into the Market Huddle. We appreciate you spending some time with us. Please give us a follow on the Twitter. You know all the stuff. Patrick, where can they find you, buddy?
You can find me at bigpicturetrading.com or follow me on Twitter at Patrick Ceresna. And Kevin, where can they find your fantastic newsletter?
Go to the macrotourist.com.
That I never read, by the way.
Yeah, you never read it. Go to the macrotourist.com and you can go to the, we have a chat. And you go to the chat. Everyone's invited. My only rule is you have to be kind and have a sense of humor. And if you can do that, you're welcome to come.
That's why I've never come, right?
Yeah, exactly. So listen. All right. Listen, we can never have too many friends. Bear market, bull market. We're just happy you spend some time together on this crazy ride. Now stick around for the after show. Okay, Patrick, what are you going to rate this bad boy?
I'm going high. 8.8.
Whoa.
It's a good beer.
Yes, lad. That's it. One for the Brits. Let's go.
Yeah, absolutely. I'm not going to go into the nines, but I actually endorse this beer. It's
because it's from Manchester.
It is. Did you ever look up whether it's caffeinated at all?
No, it's
probably
not.
No, he's just like, fuck it. I know it isn't.
Yeah, no, he's a smart ass on this shit.
Who needs to do the research, man? You know what I mean?
He just knows.
So you know what's funny? I had this picture, Patrick, where you know the one we used for the front of the show today. Can you put it up on the screen?
Oh my God! Okay, here.
Yeah, I know. I'm asking you to actually do some work. Put down your beer.
I know that's crazy, man.
Yeah.
Hold on. Let me.
So we got this.
Don't worry.
Picture.
I'll put it up.
No. I've got it. I'm just
okay.
Here.
So here he is.
All right.
There's got a picture of this dude that's got a fridge on his back. Okay. And I have just like a database of pictures from my letter that I have. And I was just looking for something funny, so I put this up there. And Daniel says to me, he goes, "That is the most British picture I've ever seen." And I was like, there's nothing in there that gives away that it is British. And I was like, how the fuck did you know that? Like, that is shocking to me that he knew, but he knew. And so, Daniel, why don't you explain to people why you knew this was the most British picture ever?
I mean, I would kind of like to give like an open like question for other British people if they listen to the podcast. But what about that picture makes you think that is British? Because I know, and I'd be interested to see if other people kind of guess it as well.
Oh, okay.
I don't want to say it, but I want to see if other people get it.
We'll see next week. We'll tell
yeah, exactly.
And we can also identify that it's not an AI picture made by Gemini.
Exactly.
I'm not going to say it.
Okay, and then the other thing that Daniel is teaching us, like that contrary to popular belief, tea has a lot of caffeine in it, and actually more than coffee. But you're explaining to us that it's something about the time release mechanism. It's like a slow release pill.
Yeah. So if you yeah, exactly. So a lot of English people drink tea, right?
Yeah.
And you can drink like 8-9 cups a day. I don't know, whatever. And tea has a slower release of caffeine. It has more caffeine than coffee, but it's a slower release, so you don't feel it as much. Whereas, you go for double espresso or whatever, and you can just feel it straight away, right? That's because it's like a quick release. If that makes sense.
So does that mean like if I have a tea and like, so if I have a coffee and it's like, boom, it hits me and it's like 15 minutes and I'm like, burning like myself. And then if I do tea, it's just kind of like a steady burn, like 2 hours later, it's still going.
Yeah, pretty much. Like monks drink green tea, right? So
yeah.
Green tea is like a monk drink, but it's to keep them awake when they're meditating. But that's just simply because it has more caffeine and it keeps them awake over a slow period of time.
There we go. See?
There you go. Fun fact.
So Patrick, you're in Europe. Do you drink tea now? Like, did you move away from coffee?
Actually, no. I still drink a lot of coffee, but I try to balance it with tea. But you know what? Danny was over. We were filming some stuff just the other week, and we tried my first attempt at fermentation. So we were trying to do some ginger beer, and I also tried making some tepache. And so Danny, the tepache did not carbonate at all, or they didn't create any of the fizz or whatever. Like it was totally flat. We fucked up, man.
Oh shit!
It didn't.
But is it sour at least? Is it like
no?
Tart
It's really
sour?
sweet.
Oh shit!
Really sweet.
Okay, I'm sorry.
We did. No, it's not some. But so like, have you ever tried that? I guess not, Kevin.
I don't have a clue what you guys are talking about. Like zero
fermentation.
Like that whole discussion. I was like, oh, I don't have a clue. It's like, I'm lost.
But you've had like ginger beer before, haven't you? Like have you tried a Moscow Mule at all or anything?
No. So I don't like those things, and ginger beer. No, I don't like any of that shit.
Oh my, that's
yeah.
Yeah. No, he's special.
How was your holiday, Kev?
Oh, it was great. Thank you. It was a lot of fun.
Am I allowed to say that on this?
I don't care. Yeah. No, I was gone last week, and that's why Cuppy so graciously stepped in for me. So I was.
So you were island hopping?
I was in Grand Cayman, yes. Oh, and it was very nice. Very nice. Very nice.
Did it not have tepache there?
I have no idea because I don't even know what that is. Like
it's fermented pineapple. It's like a fermented pineapple drink that they have, and you mix it with beer. So here's one for you, Kev.
Okay.
Right? So you ferment the pineapple skin with sugar, and then you mix it with beer. Hey, voila!
That just sounds like a lot of work. Like that doesn't sound like something like. It's the gums. No, that's all I'm gonna say is no. I will tell you something. Just one quick island story. So we went to the there's a bay in Grand Cayman that the tide and the current makes it so it doesn't turn over very often, and the type of plankton that grows in there is translucent, meaning like the same as as a lightning bug, or like when you're out, like, so it actually glows in the dark. So you kayak into this bay, and when you're there, like when you disturb the water, it actually lights up. It is the wildest thing I've ever done. Like,
actually, that is insane.
Yeah,
that's pretty cool.
It's really wild. Like, if anyone's there, make sure you go to the I can't remember what it's called, like luminescent kayaking or something. It's near Rum Point. I think Patrick, if he got there, he would just hear Rum Point, and he would never make it to the kayaks. He'd be like, I'm stuck at Rum Point. Anyways, for a big shout out to those things, because it's one of those things. I think the only other place they said that they have it is Puerto Rico. I haven't had a chance to talk to Cuppy about it, so I'm not sure if he's done it or not. But it is wild.
There you go.
Okay, well, listen, thanks for everyone tuning in. We'll see you in a couple weeks.
Cheers, everyone.
Okay, take care.